Happy New Year and welcome to this episode of Venture Underground. Once again, Sarah Lacey and Adeo Ressi here with you to break down all the things no one tells you about not just building a venture capital fund, but building a venture capital fund in this day and age, which is very different than what you're going to find on the internet if you Google how to build a venture capital fund. And what we're going to talk about now is one of the things you should be really using January to do. We talked about in the podcast at the end of the year that the last couple weeks of the year are the best time to fundraise. And ironically, the first couple weeks of the year are when everyone's kind of dead. It's sort of the opposite of what a lot of people think. So we thought, okay, well, then what should people really concentrate on the first couple of weeks of the year? So we are going to talk about annual planning and how to build a kick ass annual plan. But before we get to that, when you're raising your first fund, you can be so focused on just raising that fund, but you really have to be focused on more than that, right? Because you're building a firm, not just a fund.
You should have targets for what you want to achieve in the current fund. And I'm going to kind of keep things very simple for everybody here. If your current fund doesn't do well, and look, that happens, you're probably not going to get a bigger multiple on your next fund. And it will put a lot of pressure then on your next fund to do well for you to stay in the venture business. So you want to try and get some early indicators of success, like hey, the first of which is, can I get out of the J curve and into positive returns? And how long did that take? For some people, it takes less than a year. For some people, it can take up to 3 years. But if you're 3 years into the current fund and you haven't gotten out of the J curve, you probably should be concerned. And that will affect how you think about fund two and fund three. So let me give you like the criteria of what you're shooting for, and then how to measure that, all this stuff. So basically, you can increase each fund by a range of 2 to 5x. So if you have a $10 million fund one, you could have a $20 to $50 million fund two. And you can make a similar jump into fund three. So you could go, let's say you did really, really well on fund one. So you go for 50 million in fund two. And then fund two is a bit less exceptional. So maybe you double fund two, but that still gets you to $100 million fund three. Now, of course, look, there are scenarios where you really have a bad fund and you can't even double. That happens, right? But I think for most people, you can do 2 to 5x. And so, why you want to think a little bit about your next two funds is you want to start thinking about, hey, what's the fund size that I want to get to by the not the next fund, but the fund after that? And then you want to work backwards and say, how do I get there from where I am now? Right. And so if you're at like a $10 million fund and you want to get to $100 million by fund three, and you're on your $10 million fund one, there's quite a few paths to get there, right? You could double fund one and then quintuple fund two. Or as we said before, you could quintuple fund one. And so there's lots of different paths for you to get there.
I love that this is its own like triple, triple, double, double just for the venture industry. But I think a lot of people would watch this and say, well, like so much is uncontrollable when you're a VC because all you're doing is placing bets. The firms that we work with are investing at such early stages. As you say, these are 10-year funds. For someone who's listening to this and is like, you are just filling in a spreadsheet and reality isn't going to reflect the spreadsheet. How do you get reality to reflect this like grand plan? How can you make sure that you're out of a J curve in 3 years on a 10-year fund when you're investing that early?
There are a lot of hacks, particularly in your first fund. We've discussed this in other podcast episodes, but you can warehouse deals, right, that are already marked up. So bring value to the current fund. There's huge opportunities in secondary markets. So if you can get some good DPI by selling in secondary transactions, I mean, that's fantastic. And so that's another hack. But there's a whole bunch of hacks. We talked about another one, which is waiting to come in a little bit later on a round so that you're closer to the next markup. So there's really a long list of things that you can do to get better returns and DPI in fund one. If you can get those better returns and DPI in fund one, that sets you up to get 3, 4, 5x into fund two. And then you're under less pressure in fund two to perform to get a bigger markup in fund three, if that's what you decide to do.
We did some research recently that showed if you don't have a track record in venture capital, if you don't have, a massive network on LinkedIn, the one variable that will increase your ability to raise quickly is having a small fund size, an achievable fund size. So if my goal is to get to 100 million, is it better for me to start at say 10 because I feel like there's fewer leaps in terms of timesing that to get to that, or is my better bet to go to 5 because it's gonna be easier for me to show a return on 5 versus a return on 10? Like, how do you think about the fund size if your goal is to get to 100?
If you want to get to 100 in by, let's say, fund three, and you're on fund one, it's a much easier path from 10 than from 5, and just in terms of the multiples, because you could do a 2 on a fund that doesn't perform that well and a 5 on another fund that performs really well and get there. But the larger number that you have, the harder it is to get the multiple, the harder it is to return capital, etc. So you kind of increase your odds of getting a much better outcome with a smaller fund. The likelihood of you 4 or 5xing a $5 million fund is higher. So that then takes you the 20 to $25 million range on fund two. But you're going to have to 4 or 5x that to get to the 100 million. So if you really feel like this is the industry you're going to be in, you have some amazing deal flow and you're going to knock the ball out of the park, then the smaller fund size is definitely a way to go. If you're maybe less confident in your deal flow, but you have good fundraising dynamics, then probably 10 million's the better way to go.
It's fascinating. All right, so if we have our 3-fund plan, then how do we do the annual plan?
First of all, no matter what, you need to know where you're going. So where you are and where you're going. So you have your target fund size for whatever you either are running or are working on closing and running. And then you have an idea of where you want to get to by fund three with a rough fund size, what you think you can manage and get great returns on. And then I have like a 5-step process that works really, really well. So look, number one, you got to speak with the various stakeholders. I look at it like concentric circles where your team is the first circle. Anyone outside that, like venture partners, would be the next circle. Anyone outside that, like portfolio companies, would be the next circle, and limited partners. And then outside of that might be just possibly industry pundits, people you're looking to invest in, et cetera. So you want to talk with stakeholders and just get their views on like, hey, what should I be focusing on? How could I better support you? What might be something that if we did, you would get really excited about? Like I like to ask the question, if there was one thing we did in 2026 that you would be really proud of and excited about and tell your friends about, what would that be? And you get a lot of interesting answers, and that doesn't mean you have to do what anyone says, but it starts to inform you like, wow, if I did this, my stakeholders would, my limited partners, the founders I've invested in, my team members would be really excited to work here, be involved. So that's what I would say is step one of the 5 steps. The second step then is to sort of organize these concepts into what I would call a theme. And I like to even have a rallying cry with the theme. So it's like uh, maybe like the LPs want more communication, the founders want more communication. So it's like your rallying cry is communicate, and like I like 1 or 2 words, simple, easy to remember. You want to come up with this organizing principle that's like, hey, I've been hearing I need to communicate more from all these different stakeholders. I've heard a lot of other things as well, but I that's the one I hear the most, and so I'm gonna focus on that.
When you've done this in the past, do does there tend to be an overarching theme? Do you hear the same things again and again? Or sometimes like you have some fatal flaw in this job? Or is it like all across the board and you just have to be like, well, what do I want to work on?
Yes, is the answer, that there is usually an overwhelming thing you're hearing over and over again, but it might not be said in the same way that you expect. Like, no one's gonna say to you, "You're doing deals too slowly." You have to, like, a lot of times deduce what the theme is from kind of messy feedback.
So that's number 1 and number 2, right? You listen to the feedback, you have your call to action, you've printed it on a puffy vest like the one I'm wearing, either fur lined or not. And what is step number 3?
You gotta start measuring. So, you gotta turn everything into measurable goals. So, like, for us this year, we wanna help, launch and form and close 250 new venture capital firms. Now we help people start more firms than that through our accelerator, but we're not involved in every one of them because they're outside the US, or they choose not to work with us, or we choose not to work with them. So there are a lot of reasons. But we want to do ourselves 250, right? So that's measurable, right? It's like either we do 250 or we don't do 250, right? As part of that, right, we want to help those firms, and in order to help them close, get LPs inbound. So we want to have 1,000 LPs by the end of the year that are making more than one or more investments that we brought into the network and brought to our funds. So an average of 4 LPs each. Yet again, another measurable goal related to the first goal. So you take your organizing theme and you start turning it into goals.
If your issue was something like more amorphous, like communication, it might be send a regular newsletter or make sure that you're calling people, or you just break it down into more tangible things you can do, right?
If you feel like you have been not great communicator as a manager, which we used as a previous example, so your number one goal might be um, set up a monthly newsletter for my different audiences, right? Because you might have founders, you might have LPs, etc. Okay, so that might be number one. Number two might be produce a high quality quarterly report with thoughts and analytics. Number three might be host one event per quarter, or maybe one event for LPs and one event for founders. Number four might be do a really powerful annual general meeting, AGM, in person. Those are all measurable, right? And then you can get, what I like to do is have between 3 and 5 measurable goals. And then under those goals, have a few bullet points that give some more specificity about maybe target number of attendees, if it's like you want to do events, back to the communication, or target number of recipients in newsletters. So I try to make everything measurable or concrete in these plans, but yeah, turning it into measuring goals is very important. And then that's great. Now you have goals and some measurability and some bullets. But step four is like, what are your actionable plans, right? Well, I got to pick a newsletter system. I've got to migrate. So I sort of say, all right, in order to do this, find a newsletter system, load people into it. So you break that down into really actionable steps. And then last but not least, fifth is you got to track. I like to write everything down into a plan, and I like to look at them and say, how am I doing? For most managers, your plans probably won't change that much over the course of a year because funds kind of move at a different pace. So, depending on where you are, if you're like kind of a newer fund, you might need to change your plans. Or if you're in a startup, you definitely need to change your plans. Certainly, venture studios probably will need to change their plans. I don't recommend doing it quarterly. I recommend doing that by half, right? So you lay out an annual plan, you track things monthly and quarterly, and then you revisit the plan in the half. That's the best practice that I've seen that works. If you revisit it quarterly, it's too fast. If you revisit it at the end of the year, it's kind of too slow.
I mean, how big is the range of things that a fund would have to work on? I mean, a startup feels very different than a fund. Like, what are some of the things that you think they would get feedback on? Like, communication seems like one, deal pace seems like one.
I think 100% of all new managers can do a better job at scouting institutional limited partners. Let's say that you said, hey, this year, because I'm between Fund 1 and Fund 2, and I'm about to start raising for Fund 2, I'm gonna prepare to get institutional limited partner. That could take you most of a year to do. You gotta get all your books and records in amazing shape, build extensive target lists of these people, find connectors to them. You've gotta prepare data rooms, deal memos, all this stuff at a quality level that you might not have done in a Fund 1 that's targeted mostly, family offices and high net worths and angels and smaller LPs. So if that's, for example, one of your big objectives that you want to do, that could take most of a year for sure and involve a lot of different things across the business. So let's talk about some things that funds might want to improve on in an annual plan. So we talked about, obviously, communication is certainly one. Obviously, going after institutional limited partners is another. Improving your deal flow in an area. One way you need to look at your deal flow is, have you seen the unicorns that are coming out? You should say, hey, look, I'm working in, I don't know, biotech. In the last year, there were 10 seed companies that became unicorns in the Series A or Series B. How many of them did I see? And if it's none, you have a deal flow problem. So maybe it's like, God, I got to work on deal flow. Deal flow is another thing that takes a lot of time to fix.
Yeah.
That could take the whole year.
I mean, I would imagine, like, when I was a journalist, I would have goals like, I mean, I didn't put them in 5 steps, but I would have goals like, I wanna meet, 1 new potential source every week. Like, it's really easy to go to an event where you meet 1 new person, or, I would probably ping someone like you and be like, "Who's the most interesting person you've met lately who I should get to know?" It's not a heavy lift, it's not that much time to go to an extra coffee, but if you compound that through the year, I'm ending the year with 50 new sources, which is pretty impressive, right? And it's like that compounds
Yeah.
year on year on year on year. That's why I knew everyone in the valley, right? And so I would think also just like going to more things, being more visible. We've harped on LinkedIn. You can spend every day working on your LinkedIn, and that can compound over time.
That could be a source of both LPs and GPs. Yeah. So, in addition to those, there are other areas though that managers, definitely, in my experience, can and should work on. A lot of managers don't do their back office particularly well. They don't manage it well. They don't take it very seriously. They often delegate it to incompetent third parties. This is like the number one thing that managers procrastinate on. It's like, if it is broke, don't fix it. Taking your operations more seriously, getting your operations in order, like that's something that most managers could benefit from focusing on in an annual period. If you're between funds and you're moving on to the next fund, really preparing for that next fund could take a lot of time in the year. Just back to what we were saying before, you might want to make sure you're out of the J curve, possibly got some DPI before you open up your new fund. So you could say, hey guys, we're going to spend a year and we're just going to do everything we can to maximize the value of the current fund for our LPs. We're going to try and get DPI when we can. We're going to try and get markups where we can. So we're just going to go all in on the portfolio this year and focus on nothing else. So there's quite a few things.
Right. You listed so many that would be vital to what we were talking about at the beginning of the conversation, where you're talking about living 3 funds in the future. Do you really have to pick one?
Generally, you want one overarching theme. Once you start speaking with people, they're going to give you evidence of what's really most important. You can focus on more than one thing. I would say ideally thematically related, but not too many. It's just, it will be a diversion and distraction.
Okay, so if you're a fund and your LPs all say one thing and your portfolio companies all say another, who is more important?
Your portfolio companies are your product and your LPs are your customer. So you always serve the customer. If the LPs are telling you something, like, I'll give you another example of something that could happen, and this does happen. You went after a thesis, it made a lot of sense at the time. Maybe you were going after seed stage AI infrastructure 5 years ago. And nowadays, like, your fund size and strategy can't really buy yourself positions in AI infrastructure anymore. Your LPs may say something like, maybe you should broaden outside of AI infrastructure, and you might need to alter your thesis a little bit given market conditions. So that's a tough one. If you start hearing feedback like, "Hey, maybe you should look at this a wider spectrum or change your thesis a little bit," then, if you're hearing that, you're gonna have to probably do it, and that's a tough one to do.
Well, we should probably wrap so that people can start talking to their concentric circles and get their plan done. Are there any final words of wisdom as people sit down and start doing their plans?
It's super easy to procrastinate on this. The beginning of January is a really great time, as we opened with, to do this because you're pushing a string when it comes to LPs. Founders are a little bit better, but even there, it's kind of like a lackadaisical time in the world. So if you try to do a lot of work, you're going to be essentially pushing a string. But when you use this time to call people and check in, that works really great. So there's really no time like the present to get started. Start speaking to people, give them a random call, check in with them, and just say, "Hey, I'm working on some annual planning. I'd love to hear your thoughts on what you think we could do in 2026 that would be really exciting." And just start taking notes and make it happen. Once you begin, it's actually quite fun. So don't procrastinate, get started, and it will snowball and become a plan.
Well, as people may be able to see, I'm actually recording this from my bookstore. So I'm going to go right out and ask some customers. Thank you so much, Adeo. And we will see all of you next week.